Hi, so welcome to the live stream today. It's always a pleasure coming your way as we continue with our discussion towards the ICA November 2021 examination. And I see some of you guys joining the stream. Welcome to the stream as we begin with our discussion on the non-current assets accounting standards like IAS 16, property, plant and equipment, IAS 40, investment property, and then IAS 23, borrowing costs. We want to look at these standards and how they stack against each other and how we can actually understand these standards going forward. Note that this lecture can be used in the introduction, can be used by students writing financial reporting in level one, financial accounting in level one, financial reporting in level two, and then corporate reporting in level three, meaning that this is going to be applicable for ACCA F3, ACCA F7, and also some introductory discussion to strategic business reporting or the SBR paper in ACCA. So let's go straight up into the discussion as we continue with our thing. Let me share my screen, bring it up, and then let's go straight up into it. So tangible non-current assets. Now, the big question we ask ourselves always is, all right, so when we talk about non-current assets, what are non-current assets, and then what do we do about it? And we're going to be going through the discussion and going through and sharing some documents in here with you. Now, the material I am using here is the ACCA F3 paper as well as the ACCA F7 book, study materials by BPP. That is what I'm going to be using for my slide and going through the discussions with you as we look at what it is that we need to do. So let's begin the discussion real quick on non-current assets and current assets. Now, so when we say non-current assets, what are non-current assets? And when we say current assets, what are current assets? These are very critical definitions that we want to start with off the bat. So off the bat, when we talk about non-current assets, they are assets which are bought by the business for continuing use. So tangible non-current assets are those with physical form. Now, as we go into the discussion, we're going to be looking at the differences between tangible assets and intangible assets. In a nutshell, when we say something is tangible, it means it has a physical substance. It means you can touch it, you can hold it, it has a physical form. But when we say something is intangible, it means it does not have any physical substance in that case. And we're going to be getting into the discussion with that. But then one thing you need to understand is that non-current assets are bought by a business for long-term use. So when we talk about non-current assets, these are bought for long-term use. So non-current assets are not used by for short period of time. It's not within a year. It's more than a year that non-current assets are used by businesses in that case. But note that current assets are assets that will be realized or consumed or sold in the normal operating cycle of the business. In that case, if you're a good student and you remember what your balance sheet, your statement of financial position, realize that current assets will include things such as, now this is according to IAS 1, presentation of financial statements. You realize that that is going to be the issue in inventory. So an inventory is a current asset. I'm going to talk about trade receivables. That is a current asset. Okay. Cash is a current asset and all that in that case. So those will be current assets. So current assets are usually realized, they are consumed, or they are sold in the normal operation of the organization. Also, non-current assets held for sale are also recognized as current assets. So non-current asset held for sale will be recognized as current assets, and that is in accordance with IFRS 15, non-current assets held for sale and discontinued operation. And we'll look at some of these later on as we continue with our discussion. So what are we saying here? When we say tangible non-current assets, we are referring to non-current assets with physical substance or with physical form. whilst intangible assets are the assets without physical substance or physical form. That is one thing that you need to understand in that case. Then the key question we need to ask ourselves as we begin to boil these down is the difference between a capital expenditure and then a revenue expenditure. Now, as their name suggests, a capital expenditure is an expenditure whose consumption goes beyond one accounting year, whilst a revenue expenditure is an expenditure whose consumption is within a year. All right, so acquisition of non-current assets is a capital consumption or capital assets in that case. For that reason, we said that capital expenditure is expenditure which results in the acquisition of non-current assets or improvements to existing non-current assets. So maybe we are acquiring non-current assets, that is a capital expenditure, or we are improving an existing non-current assets, that will also be seen or regarded as a capital expenditure. Now, when we talk about capital expenditure, it's very important for us to understand how to treat it and how to recognize it in the financial statement. Usually, what you should know is that capital expenditure is not charged as an expenses in the statement of profit or loss. It is not charged as an expenses. Why? Because it is about an acquisition of an asset, or it's about the improvement of an existing asset. For that reason, capital expenditures are capitalized and included on the statement of financial position of the organization, which means that depreciation and amortization will be charged every year, and that is what will be taken to the statement of profit or loss account. So when we buy tangible non-current assets, what is going to be happening here is that we are incurring capital expenditure. Now, that capital expenditure cannot be written off in the profit or loss account. Instead, it's going to be recognized. It's going to be recognized in the statement of financial position. Then every year, we are going to be charging two things. That is amortization if it is an intangible asset, or depreciation if it's a tangible asset in that case. Now, this amortization and depreciation is going to be going into the statement of profit or loss, or the income statement, or what we call the statement of profit or loss and other comprehensive income. So that is the idea about how capital expenditure is dealt with. It is not recognized in the profit or loss account. Instead, it is recognized on the face of the statement of financial position. Then every year we're going to be charging amortization and depreciation, and that amortization or depreciation is what is going to be recognized in the statement of financial performance, or the statement of profit or loss for the period under consideration. The second thing we need to also note about capital expenditure is that it results in the recognition of non-current assets in the statement of financial position of the business. And I've also stated that in the chart that I just drew. So that is the idea about capital expenditure. It is capital in nature. We don't write it off in the profit or loss. Instead, we recognize it in the statement of financial position of the business. Then every year, the annual charge or the annual allocation is what is taken to the statement of profit or loss for the period. Then let's look at revenue expenditure. Like the name suggests, revenue expenditure is simply going to be the expenditure which are incurred either for either of the following reasons. One, for the purpose of trading or trade of the business. So because of the services we are rendering, the products we are producing, or the undertaking of the organization, we incur some cost in the day-to-day running of the organization. The cost we incur in the day-to-day running of the organization is going to be recognized in the profit or loss account in the financial statement. So example of that could include things such as selling and distribution expenses, administration expenses, finance charges. Then number 2 about this is to maintain the existing earning capacity of non-current assets, to maintain the existing earning capacity of non-current assets. So repairs and maintenance is actually a revenue expenditure, and these are recognized usually in the profit or loss account in that case. So in a simple language, what we are saying here is that whilst capital expenditure is for on long-term assets, long-term benefits, consumption of it goes beyond one accounting year. Revenue expenditure, its consumption is within one accounting year in that case. So capital expenditure goes beyond one accounting year, but then revenue expenditure is less than one accounting year. Does it make sense? It's less than one accounting year. That is the idea about the difference between capital expenditure and revenue expenditure. That's the difference between capital expenditure and revenue expenditure. Now that we have that up, let's look at some examples of what constitutes capital expenditure, what constitutes revenue expenditure, and how we can recognize these in the financial statement of an organization in that case. So if we have a company, how do we recognize these? So let's look at some examples we have here from our book as we take the discussion. Question 1. The purchases of a property. Example, an office building. Is that a capital expenditure or a revenue expenditure? Of the bed, that is a capital expenditure, because when we are buying a property, we are buying an office building, the consumption of it will exceed one accounting year. In other words, that building will be used more than a year. For that reason, we account for it in accordance, or we recognize it as an asset in the financial statement of the company as a capital expenditure. 2, the annual depreciation charged on such property. The annual depreciation we charge is a revenue expenditure. Hence, that will be recognized in the P&L account of the organization. That is the statement of statement of profit or loss of the organization. C, solicitors' fees in connection with the purchase of such a property. So we are buying a building, but we need to deal with some lawyers to be able to structure the deal, find out the ownership of the building, so that we are buying a building that has no issue, that has no case along it. So because that cost relates directly to the asset, that is going to be recognized as a capital expenditure. In other words, we're going to be including the solicitor's fee we pay in the purchases of the assets in the initial cost of the asset. This is in accordance with IAS 16, property, plants, and equipment. And I'm going to expand on this in a moment as we move ahead with the discussion. 3, the cost of adding extra storage capacity to a computer used by the business. We are adding extra storage capacity to a computer we are using as a business. Now, if an organization is adding extra capacity to a computer it is using as a business, then that is going to be like an improvement of that asset. So that is also going to be a capital expenditure, and it will be included in the cost of the asset. Then computer repairs and maintenance. Repairs and maintenance, that is not a big deal. So that is going to be a revenue expenditure. We recognize that in the statement of profit or loss of the organization because that is expenses. Repairs and maintenance costs, they are expenses that the organization incurs on their assets, and those are not capitalized, but instead written off in the statement of profit or loss or in the financial statement of the organization. F, profit on the sale of an office building. If we sell an office building, that is going to be a revenue that we are going to be getting, and so that is going to be recognized in the statement of profit or loss or in the income statement of the organization for the period under consideration, and that is going to be mentioned and looked at in that case. And that is going to be more or less like a capital income or a capital gain that we are getting because we are selling the building. So that is a capital income or capital gain. Then revenue from sales by credit. Revenue from sales by credit is also an income, but that is going to be more or less like a revenue for the organization. So that's going to be a revenue for the organization, but this is going to be like a capital income for the organization because you see, usually, so this is going to be more of like an income coming in, and the sales by credit card will come in as a revenue for the organization under consideration. Then the cost of new plants. Definitely, that is going to be under or a capital expenditure. The organization is buying a new plant. What do? We recognize it as a capital expenditure in the financial statement of the organization. Then customs duty charge on the plant when imported into the country. So it means that we bought the thing outside of our home country. So let's say we procure the good, something from China, and we are paying custom duties. Now, because it relates to the plants that we are buying, it is directly related to it. So that is going to also be included in the initial cost as per IAS 16, property, plants, and equipment. So that is also going to be a capital expenditure in that case. Then the carriage cost of transporting the plants from the supplier's factory to the premises of the business purchasing the plants, that is also going to be a capital expenditure. So for instance, you buy something from my warehouse and you are incurring the carriage cost from my warehouse, whatever. Let's say my warehouse, it's in Tema, and let's say that you are in, say, Kokomlemle. In that case, then what do? You are going to transport the thing to Kokomlemle, whatever it is. Then what is going to happen is that the money you're going to pay, the carriage cost you're going to be incurring, will be included in the initial cost of the plants that you just bought from me as an individual or as a business in that case. Then K, the cost of installing the new plants. That will also be included in the initial cost of the assets. So that is also going to be a capital expenditure as per IAS 16, property, plants, and equipment. And then the wages of the machine operator, the one who operates the machine, that is a revenue expenditure. So it's not a big deal for us. So we're going to be recognizing that as a revenue expenditure, and that will be recognized in the profit or loss statement of profit or loss of the organization for that case. Now, in case we are preparing the consolidated financial statement also, which is something we'll look at later on, these will be going into the expenses aspect of the organization, and we'll look at that. So these are some examples to help us distinguish between revenue expenditure and then capital expenditure, as well as talk about capital income and then revenue income. And I see some of you guys joining the stream. You are welcome. This is episode 4 in our IFRS masterclass, and we are looking at the non-current asset standards like IAS 16, IAS 40, and IAS 23. I see some of you already with a thumbs up on the video. Share the video. Let us reach as many students as possible. And if you have any questions, put it in the chat because I'm going to be answering any questions that you have and assist you to clear your thoughts on them. So these are the things you need to understand about that. So now that we've distinguished between revenue expenditure and capital expenditure, let's dive a bit deeper into IAS 16 and kind of begin the journey of what exactly IAS 16 wants us to know about and wants us to do. Now, IAS 16 property, plants, and equipment, it's a unique accounting standard because when you are doing financial accounting level 1, financial reporting level 2, or corporate reporting or strategic business reporting level 3, IAS 16 is a fundamental standard which you want to make sure that you understand every bit of it or every part of it. And I'm going to be really expanding on this for you to see exactly how all these come together in that case. Now, the standard In a simple language, the objective of this standard is simply to prescribe the accounting treatment for tangible non-current assets used for the business. Now, when we come to dealing with non-current asset, before I get excited, let me just provide you with some blueprints before we get some questions coming in there. When it comes to dealing with non-current assets, we classify and account for non-current assets based on how the entity is using the non-current assets. Remember, when we talk about non-current assets here, it could be either the entity leasing the assets, so in which case there will be a lessee accounting for its right of use in that particular situation, which will go by the principle of IAS 16, or maybe the company bought the assets outright. So remember, when we say an asset, we define an asset as resources controlled by an entity. Hence, the key word here about these non-current assets is, do we control it? And you remember, we've defined the definition of control. Control simply means we are directing the usage of the asset, and most importantly, future economic benefit in the asset flows to the entity. So don't get it twisted here. When we are talking about non-current assets and their uses, we are referring to the non-current assets that the entity has control over as an organization. So when it comes to dealing with non-current assets, two things that that we can talk about. There can be what is called owner-occupied non-current assets, and then the non-owner occupied non-current assets. So owner occupied non-current assets, and then the non-owner occupied non-current assets. When we say owner occupied non-current assets, it means that the entity controls the assets. Remember, the word here is not owning the asset. Okay, because it's not about owning the asset, it's about controlling the asset. So when we say owner occupied assets, it means that the entity controls the assets and uses the assets in the day-to-day running of the organization. So if we control the assets and we use it in the day-to-day running of the organization, it is called owner-occupied assets. For that reason, if we are using it for the day-to-day running as an office space, as a showroom, as a warehouse, or even as a car park, or whatever it is, we are using the asset for our day-to-day activities, then we are going to be accounting for that asset in accordance with IAS 16, property, plant, and equipment. We will account for the asset in accordance with IAS 16, property, plant, and equipment. However, where the entity controls the asset, but the entity is holding the asset and not doing anything with the asset now. For instance, we buy land, but we are not doing anything on the land right now. So it means that probably we are holding on it for capital appreciation. Or better still, the entity controls the assets and it has leased it out. Remember, when we say lease here, from the perspective of the lessor, it means an operating lease. Okay, it's an operating lease we're talking about here. It's an operating lease, then we can account for it. So sometimes the entity controls the assets, but it doesn't use it for its day-to-day running. So either we've not determined what we would use the asset with for, so we will account for it as a non-owner occupied asset, or we have sublet the asset for some inflows coming in, and subletting means it's an operating lease. In that case, we are going to be accounting for it in accordance with IAS 40, investment property. So when an entity controls an asset, but the entity is not occupying the asset, but the entity had sublet the asset as an operating lease, then we account for it as an investment property in accordance with IAS 40. But if the entity leases the asset out and it is a capital or finance lease, then it will not be accounted for as an investment property, but it will be accounted for in accordance with IFRS 16 lessor accounting. And that is very critical. Remember when we did leases last week, and I explained that principle to you very well. So our focus right now is to look at IAS 16. So anytime you hear about IAS 16, it means we are talking about the assets that an entity controls, which the entity is using for its day-to-day running as an organization, for its day-to-day running as an organization. I hope you get that very well. Right. So now that you know what IAS 16 is about, then we got to take some definitions from the standard and find out exactly what we need to know about. So IAS 16 provides the definition for four key things that we need to know about, which sets the basis for us to actually begin to understand how the standard actually works. So IAS 16 gives us some definitions. So let me bring up a red ink here. You ready for this? Four definitions. So property, plants, and equipment. What is property, plant, and equipment? Now remember, the name of the standard is property, plants, and equipment. So what is property, plants, and equipment? IAS 16 provides us with a definition of property, plant, and equipment. What is that? So property, plant, and equipment are tangible assets that, one, are held by an entity for use in the production of or supply of goods and services, for rental to others, or for administrative purposes. That's property, plant, and equipment. Or are expected to be used during more than one period. So something that we hold as an entity, and we use it in the production of our goods, or in the rendering of our services, or for administrative purposes, can be categorized, can be seen as property, plant, and equipment. It's the broad thing. Or it is going to be something that we expect to use in more than one period, which means that in a nutshell, with property, plant, and equipment, it means we are talking about capital expenditure here, right? What we discussed a moment ago, we're talking about capital expenditure here. Then the key thing we're going to be looking at will going to be the cost. So when we say cost, what is cost? Because one of the things we're going to be looking at in a moment is the initial cost of a property, plant, and equipment. What should be the initial cost of a property, plant, and equipment? That is very critical. That is very important for us to know about in that case. So when we say cost, what is it? According to IAS 16, cost can be defined as the amount of cash or cash equivalent paid, or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction. Did you get that? Did you get that very well? So when we say the cost of an asset, we mean the amount of cash or cash equivalent paid, or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction. Now, the reason why you need to make sure you understand the second part of the definition is that when we say a company incurs, let's say, a cost of, say, $10,000 to acquire an asset, it may not necessarily mean the company wired cash for it. Neither would it mean the company bought it on credit. But sometimes the company could settle that in maybe shares, or if you want, in equity. Okay, so instead of the company paying the supplier for the service for the asset that they have bought, they would rather say, hey, we don't have money, so we owe you, right? But we want to give you shares. So in that case, the fair value of the shares that they are giving to the supplier from whom the assets are bought becomes the cost of the asset. I hope you are getting the idea. That is what the second aspect of the definition has, that or the fair value of other considerations given. The fair value of other consideration given to acquire an asset. So we are not going to always buy an asset with cash, buy an asset on credit, but sometimes an entity may settle the acquisition of an asset either in shares or even in an exchange. So for instance, you give me whatever, let's say you give me a microphone, maybe I buy a microphone for you, and guess what? I lecture you or I teach you. What does that mean? It means that we are doing an exchange service. So the fair value of the service I'm rendering to you becomes the cost of the microphone that I'm buying from you. I hope you're getting the idea. So when we say cost, that is what we mean as per IAS 16, property, plants, and equipment. Then the next word that is going to be flying around a lot as we are looking at this IFRS masterclass is fair value. Fair value. Fair value. Now, in a simple language, when we say fair value, we're talking about the value at which an asset can be exchanged or a liability settled between market participants in an arm's length transactions. In an arm's length transaction. So when we say the fair value of something, we are simply asking, okay, if I'm selling it, how much am I going to get? Or if I'm owing you, how much am I going to pay you? So the money that I will receive if I should part way with this asset, or the amount that I'm going to actually pay you today, if I am supposed to pay you how much I owe you, is what refers to as what? Fair value. So what do we have there? Fair value is the price that would be received to sell an asset, very important, sell an asset, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, you want to be careful about this definition because it is going to be flying around when we are doing IAS 36, impairment of assets, IAS 38, intangible assets. When we are even doing IFRS 9, financial instruments, you're going to be seeing fair value flying around a lot. So when we say fair value, we are referring to the price that will be received. How much we're going to be receiving for selling an asset or to settle a liability between market participants at the date of the transaction. Then another key thing that is going to be running around a lot is the issue in relation to carrying amount. So there is going to be two things you need to understand of the bet. When we say fair value, it's not the same as the carrying amount or the carrying value. Please know that carrying amount and carrying value can be used interchangeably. When we say carrying amount of an asset, it's the same as the carrying value of an asset, all right? It's the same as the carrying value of an asset. So we've already defined fair value as the amounts to be received for an asset, the amount to be paid to settle a liability between market participants at the measurement date. But the carrying amount or the carrying value of the asset is simply the cost of the asset minus any accumulated depreciation. The cost of the assets minus any accumulated depreciation. And we're going to be getting into that one also in a moment as we move ahead with a discussion in that case. So carrying value is going to be equal to the cost minus accumulated depreciation or impairment. So let's look at the definition we have here. Carrying amount is the amount at which an asset is recognized after deducting any accumulated depreciation and impairment losses. The amount at which an asset is recognized after deducting any accumulated depreciation and impairment losses. So like I said, impairment is a standard we'll be looking at later on under IAS 36. That is impairment of assets. There is IAS 38, intangible assets. We're going to be looking at these much later on in the series or in the discussion as we proceed with that. So these are four key definitions that we need to understand when it comes to dealing with property, plants, and equipment in that case. So, any questions for me? I see some questions coming up. Any questions for me? So we've looked at the difference between capital expenditure, revenue expenditure. We've looked at also the issue talking about the 4 key definition: property, plant, and equipment. What is the cost of an asset? What is fair value? And most importantly, what is the carrying amount or the carrying value of an asset? Now, if you are listening to the audio of this lecture on Anchor, you can leave a message on it, or any podcast feed, you can send us a message on it. If you are watching live also, you can put the question in the in the comment section, and I'm going to be answering all. So let me look at a couple of questions real quick as we begin to dive a bit deeper into this discussion. I see some of you guys joining. You are welcome. Share the video. Let's get some engagement on the video. Facebook, we're getting a couple of engagement on the video on Facebook, and that is very great. Eric Otre, Nana Ej Sikapa, Langu Peter, Blimi Senior, Mamani, Wumpini, Alhaji Ahmed Idrisu, Blessing, Malungwini, Ahmed. Let's talk after the class. Send me a message on WhatsApp. I don't know if you are still watching though. And others, thank you very much for your thumbs up and the sharing on Facebook. Nawa Kamona said, I love your work. Thank you, Nawa Kamona. Forgive me if I don't mention your name right, okay? Deepin Bimali said, hello, said, hi, Bimali. I hope you're doing well. Kiva said, hello, and thanks. And thank you for the examples. You're welcome. Augustine A. Barton said, hi, everyone. Hello, Augustine. Pomari Yaira. Sorry if I don't mention your name. Okay, well, okay, but I think Yaira, that's Blessing, I guess. Something like Nhyira Blessing. That's an airway name, I guess. I guess I got that right. Yaira Kujo said, great work. Thank you, Yaira. Jackson Oraf said, great work. Thank you, Jackson. Stan Obi said, what is arm's length? Like what we define, arm's length simply means between market participants, people who are players within the market in that case. Bimi Senior said, please, can the cost of an asset be equal to its fair value? Yeah, definitely, especially, no, not the same assets, not the same assets. So it depends on the context in which we are looking at it for it. Because if I'm selling the asset, to me, that is going to be the fair value of the asset. So when you are buying it, that becomes the cost to you. However, this is the sweet spot. When you buy the asset at that fair value, to me, you may have to incur other costs, like what we spoke about, the carriage cost, the installation cost, and all that, to come to the total cost of the asset. Does it make sense? So fair value of an asset cannot always be equal to the cost of the asset, because it depends on where we are standing and what exactly we are talking about. Abdul Fattah Ishaku said, good evening, sir. More health for you. Amen. Good evening, and I hope that you're doing well. Abdul Fattah Isakahu. Right, so any questions, any comment, put it in the chat for me. I'm reading all of your comment, and I'll be replying to all of them for you as we move on with our discussion in that case. As we move on with our discussion in that case. Now, remember that the ICA results have been released, and I hope that by now you have checked your results, you've seen your stand wherever you are at, and we receive a couple of messages from you guys. I mean, those who are not directly enrolled in our courses, about how our YouTube channel was helpful for them in their examination and how it was for them to pass the exams. And we really liked what we got from you guys, and we will continue to provide you with some assistance that you need in order for you to become successful. Know that we are going to be starting our live sessions online sessions and as well as face-to-face from 5th of July 2021. And you can join and study directly under my mentorship, get access to all our lecture videos, all our ebooks, all our question kits, and join our live sessions, our extra classes and all that, to be able to assist you in order for you to prepare well for the examination. So if this is something you're excited about, you can visit NhyiraPremium.com. The link is in the description to this video, or you can call or WhatsApp us. The number scrolling below the screen is 050-114-9296. You can call us. Maybe you want some assistance or you want to clarify something before you enroll. You can call or WhatsApp us and it will be clarified for you. Or probably you want to see the timetable even before you enroll in a course. All that, you can check that out. And I hope that I can assist you with our team here to help you in order for you to pass the examination and most importantly, become successful. So let's see. Abdul Bima said, thank you so much, Nhyira. You are welcome. George Niama Somoa said, hello, Nhyira Premium. I'm really learning a lot. Fair value equals market value, whereas current value is same as net book value, right? Yeah, we could say that. Net book value is the old school of carrying amounts, just like how statement of financial position is the new school for balance sheet. All right, so now you don't say balance sheet, but you say statement of financial position. So yes, what he's saying is true, George there. Bima Senior said, thank you so much, Nhyira. Okay, you're welcome. Blessing Vutomi, forgive me if I don't mention your name right, okay? Please forgive me. But Blessing Vutomi, my namesake. Evening, sir. Can you please assist me with depreciation dates? I sometimes get confused when it comes to dates. Yeah, we're going to be getting into that for the computations and other things, because when you're dealing with the accounting standards, one of the things you need to be critical about is the dates that the asset was acquired, as well as the year ended for the financial statement that you are preparing, so that you'll be able to either charge a full year depreciation or have a pro rata depreciation amount. So the period of charging depreciation, we're going to be getting into all of that as we continue with our discussion there. Z Madonsila, forgive me, but I think I'll stay with Z. It's like Z World, the TV channel. Watching from South Africa, thank you so much, sir. You are much appreciated. Always a pleasure, and I love you. Thank you for appreciating and supporting us always, Z. Good evening, Nhyira. Great work. Thank you, Vincent. I hope that you're doing well. Godfrey Lumbala said, really enjoying your videos. Okay, that is great, with a thumbs up there. Thank you very much. Thank you very much. Now, in case you've not subscribed to the channel, I don't know why you've not subscribed to the channel, but make sure you hit the subscribe button and the bell notification icon and select all notifications. That way, when I go live and you have even forgotten, you will get a notification sent to you directly by YouTube. Then you'll be able to join the live stream, ask your questions, then I can assist you much better. So let's go back. Let's get into our discussion. Now, like I told you when we started with the journey on IFRS, when you take accounting standards, there are a number of things that you need to know about. Number one is the objective of the standard. Number two is the scope of the standard, what it covers. So the objective of the standard, the scope of the standard, what it covers, very important. Number three, you need to understand the key definitions that the standard has that you need to know about. So key definitions. Then you need to look at the recognition criteria for the standard, not all standards, but we'll get into this also in a moment. Then you need to look at the initial measurement. Then you need to spend some time to look at subsequent measurements. And then disclosure requirement. It's a lot, right? Depending on your level, a couple of things could come up at all costs. So you must know the objective of the standard. You must understand the scope of the standard. You must know about the key definitions. You must understand the recognition criteria. You must know about the initial measurement. In other words, what should constitute the initial cost of the asset, and then the subsequent measurement after we initially recognize the thing. How do we subsequently recognize it in our books to determine the carrying amount of the thing? And then disclosure requirements. What do we put in the notes to the financial statement of the organization? So we've mentioned that the objective of the standard is to prescribe the accounting treatment of owner-occupied non-current assets. And it is in the light of that that we've also spoke about the scope of the standard, which means that we are referring to the property, plant, and equipment that the business uses in the day-to-day running of the organization as administrative asset or something like that. We've looked at the key definitions that we need to pay attention to. 4 of them: property, plant, and equipment, the cost, fair value, and then the carrying amount. Now we want to go to the recognition criteria. So when we come to non-current assets, what is it that when we see we can recognize non-current assets? Note that in order for us to recognize non-current assets in our financial statements, it must meet the definition of an asset. It must meet the definition of an asset. That is the background. That is the backdrop, if you want, for us to tell if this is supposed to be recognized as an asset or not. So to recognize a transaction or an item as an asset, it must meet the definition of an asset. Now, what is an asset? What is an asset? We define assets as resources controlled by an entity as a result of past events from which future economic benefit flows to the entity, right? So that is an asset. That is an asset. So the backdrop of the recognition is that it should meet the definition of an asset. Very, very critical, meaning that the entity controls the asset. And remember, we said that when we say the entity controls the asset, it simply means that the entity directs the usage of the asset, and it also means that the economic benefit in the asset flows to the entity. So before an item can be recognized as an asset in our financial statement as an organization, it should meet the definition of an asset. After that, IAS 16 went ahead to provide us with 2 other things that we need to know about in order for us to incorporate it into the financial statements. Number 1 is that it is probable that future economic benefit associated with the assets flows to the entity. Are we the ones going to be receiving the future economic benefit in the assets? If yes, we go for it. Then 2, the cost can be measured reliably. The cost can be measured reliably. So what is the recognition criteria for assets, property, plant, and equipment? Future economic benefits will flow to the entity. The cost can be reliably measured. But at the background of that is that something will be recognized as property, plant, and equipment or as an asset if it meets the definition of an asset. Once we've spoken about the initial recognition, the next thing we will look at is initial measurement. In other words, what should constitute the initial cost of a property, plant, and equipment? What should constitute the initial cost of a property, plant, and equipment? Now, I gave you some understanding about this when we were looking at the differences between capital expenditure and revenue expenditure in the beginning of the lecture. In that case, the initial, according to IAS 16, the initial cost of an asset shall be the purchases or the manufacturing cost, and other direct costs incurred in bringing the asset to its present use. I mean, that's a simple thing we need to understand there. The initial cost, the initial purchase cost or the manufacturing cost of the asset, and other directly attributable costs incurred in bringing the asset to its present use. That is the fundamental thing we need to understand when we talk about recognition or the initial measurement of the assets. Now let's go back to our slide and let's pick up some things from here. So once an item qualifies for recognition as an asset, it will initially be measured at cost. So what constitutes that initial cost? What constitutes that initial cost? So you want to be careful and stay with me very well here, because this is going to be critical for you in order for you to be able to really understand and know exactly what we're talking about here. So IAS 16 lists the components that make up the cost of a property, plant, and equipment as follows. 1, the purchases price, how much we paid for it, including any import duties paid. So for me to be excited about it, let me put it in a table form like this. So purchases cost, like this. If we bought it from other country, import duties shall be included. Let's go. Initial estimates cost of dismantling and removing the item and restoring the site which it is located. I love this. Now, this is an accounting standard we'll be looking at later on, and that is according to IAS 37, provisions, contingent liability, and contingent assets. Provisions, contingent liabilities, and contingent assets. So the purchases cost, import duties, please know that any discount we receive has to be excluded, okay? Has to be excluded. So the cost of dismantling and removing, so let's see, dismantling and restoration cost will come in. Like I said, this is going to be in accordance with IAS 37, provisions, contingent liability, contingent assets. Possibly we will look at that later on, and we're going to bring in the present value, because it's always something we're going to pay at the end of the estimated life of the asset. So we'll discount it into present terms, okay? We'll discount it into present terms, and that is what is going to give us the dismantling and the restoration cost. So that will be included in the initial cost as well. Then the third item that IAS 16 lists is directly attributable costs of bringing the asset to working condition for its purpose. Directly attributable cost. Directly attributable cost. Directly attributable cost of bringing the assets to its present use. Directly attributable cost of bringing the assets to its working condition or present use. So when we say directly attributable cost, what are some of the things we're talking about here? Stay with me carefully. 1, the cost of site preparation. For example, leveling the floor of the factory so the machine can be installed. Initial delivery and handling cost shall be included here. Installation and assembly cost included here. Any professional fees we paid shall be included. So payments that we made to lawyers, to architects, to engineers, all these shall be included in the initial cost of the assets. Then cost of testing, whether the asset is working properly, after deducting the net proceeds from selling sample produce when testing the equipment. Very, very important, because after installing the machine, We need to test it to see if it is working the way it has to work. So that testing of the machine shall be included in the initial cost. However, whilst testing, if there was a sample product we produce and we sell it, the revenue from that will be used to reduce the cost we incurred at the testing stage. I hope you get a clarification on that. That's very, very critical in that case. This is also the same as, let's say we are, how do we call it? We are constructing an asset. We are constructing a property. So if you are constructing an asset or a property, and we are not done, okay, we are not done yet, but then we rent the place temporarily, and then we receive some income coming in. Can that income be used to reduce the initial cost of the assets? The answer there is no. That income would have to be recognized directly as an income in the statement of profit or loss. I think we'll get into some of these later on. Then staff costs arising directly from the construction or acquisition of the assets. Key word here is directly. You want to be careful. Directly from the construction or acquisition of the asset, not the usage of the asset. Immediately we start using the asset, any staff cost that we incur will not be capitalized, but then will be expensed in the financial statement. Will be expensed in the financial statements. Because of the similarity and the treatment of the staff cost, the book gives us some ideas about exactly what we need to look out for. So only the staff cost arising directly, keyword, I've mentioned that, from the construction or acquisition of the asset can be capitalized as part of the cost of the asset. The cost of training staff to use the new machine cannot be capitalized. So let's say we bought a new machine. Okay, let's say we bought a new machine, and when we bought the new machine, our people don't know how to use the machine, so they need to go for a workshop. We need to train them to use the new machine. IAS 16 is saying that the cost we incur in training the people to use the new machine cannot be capitalized, but must be written off or expensed in the statement of profit or loss. Why? Because we cannot guarantee that those staff will stay and use the assets. We cannot guarantee. So, and you know this already, or you should know this, staff training cost is always expense, never capitalized, because you are not guaranteed that the person will stay with you. But there are some exceptional cases, and this is exceptional. If the entity has a binding contract with the employees that they cannot leave the organization after a number of years, then in that case, the entity may, listen carefully, the entity may capitalize the training cost. Why? Because of the binding contract. But if there is no binding contract, I mean, if I'm working and I don't like your salary any longer, I can go somewhere else. Or if I'm working and I realize that, oh, my wife needs some help, and or myself, I don't like to work again, I want to just chill out with my wife in the house, then I just stop working. The training you've given me is free. I've taken it away. So staff training costs is always written off. However, if it relates directly to the construction or to the acquisition of the asset, that is what is included in the initial cost of the asset. I hope you get the idea here. I hope you get the idea. So what are we saying? We are saying that the initial cost of an asset is the purchases cost, is the import duties, is the dismantling and restoration cost, as well as directly attributable cost. When we add these items together, that's what gives us the initial cost of an asset. It is this initial cost that is entered into the double entry as debits, what? Property, plant, and equipment. And then we will credit cash, for the payments that we make, or payables, if some of them are outstanding. In that case, some of the expenses are outstanding. So that is the double entry for the initial recognition. But then we've seen the things that can be included in the initial cost of the asset, in the initial measurement of the asset. But somebody will ask, what are some of the things that cannot be included? What are some of the things that cannot be included? Any ideas? Yes. So let's look at some of the things that cannot be included. Some of the things that cannot be included. According to IAS 16, the following cannot be included in the assets. Why? Because they are not directly attributable to the cost of the assets. One, expenses of operations that are incidental to the construction or development of the items. So expenses of operations, those ones, we write it up because it may not directly be connected with the assets really. So let's say we are constructing an asset. Stay with me carefully here. And we employ our staff, okay? We have an accountant as an organization, and the accountant goes to the site to what? Look at the invoices, the item, everything, so that he will come and record them in the books of the company. That is not and we give him any allowance. The allowance we give him doesn't qualify for it to be included in the initial cost of the assets. That should be written off directly, because the accountant's job is not because of the asset we are constructing. If we employed him exclusively for the construction, then how much we pay to him will be included in the initial cost. Are you getting the idea? So if we are manufacturing an asset and we employ labor, or we employ architects, or we employ designers, and the money we pay them is exclusive to the building, to the construction, then it will be capitalized. If not, we write it off. We write it off. 2, administration and other general overhead costs. Like for instance, like I said, the computers we are using in our office, I mean, the administration block we are using, you cannot say, oh, we are incurring electricity bill, so let's apportion this to the new construction when it is an administrative electricity bill. I mean, you will pay it either way in that case. So those are also not going to be included. Startup and similar pre-production costs. Usually pre-production costs capitalized separately, and they will be amortized over a number of years. That is judgmental to the organization. So those things will not be really included in the initial cost of the assets. So any pre-production cost will not be included in the initial cost of the asset, but will be capitalized separately on the face of the statement of financial position and then amortized over a certain number of useful life, depending on the organization. The next one, initial operating losses before the asset reaches planned performance. Initial operating losses. Now, this is in accordance with IAS 37 provisions. I mean, when we are making losses before an asset reaches any planned performance, those are expenses. We cannot include it in the initial cost of the asset. Then staff training costs, we've already said that. Maintenance contracts purchased with the assets, that's a revenue expenditure. So maintenance contracts, what do we mean by that? What do we mean by that? So all these items will be expense in the financial statement. So let's say, for instance, we buy the assets, then as part of the deal, there has to be some regular maintenance. Maybe every 6 months, there has to be some regular maintenance on the assets. And then we've signed a 3-year contract with a supplier, and we've paid them. What we're saying here is that that maintenance part should not be included in the initial cost of the asset. That maintenance part is going to be recognized or expense in the P&L account, and then the amount outstanding will be recognized as expenses prepaid under current assets in the statement of financial position. Did you get that well? So that we bought an asset. Let me bring this up. So we bought an asset for whatever. Let's say we bought an asset for say $20,000, and we sign a maintenance contract $5,000 for say 5 years. Okay, which means that hypothetically we're gonna be spending $1,000 every year. $1,000 every year. What are we saying? We're saying that this 5,000 cannot be included in the initial cost of the asset. The initial cost of the asset will still be 20,000, but this 5,000 will be amortized over 5 years. So that after the first year, what's going to be happening is that the balance 4,000 will be under current assets as expenses prepaid on the face of the statement of financial position. On the face of the statement of financial position. So that is what you need to understand about the initial recognition. The initial recognition. Any questions for me quickly? Any questions for me quickly? Let me see. I see some questions and comments. Let me bring them up real quick as we continue with our discussion. Augustine said, please, do you have any textbook for business law? Not, I've not published a book on business law, but I have a manual on business law that is available to the students who I teach business law. So it is not something that is available for the public, but there is a manual that I have on that. It's just a study kit that I did for the students. Quote unquote said, will you talk about entity specific value? Yeah. Stan Obi said, say, I don't understand how dismantling B VOST is VAT. Now, I think you have some typing. Okay, how dismantling cost is at the end of the year. I don't get your question, but I think this is what I said that you see, the dismantling cost will be incurred at the end of the economic life of the asset. All right. So if the asset has an economic life of say 10 years, then it is after the 10th year that we are going to be dismantling the asset. We will landscape the place and we will restore the land to how it was prior to installing the asset. So since that money will be paid in 10 years time, we will bring it into present time. So if the money will be whatever, $10,000, how much is $10,000 today in 10 years time? So we'll bring it to the present value, and that will be below $10,000, and that is what will be included in the initial cost of the asset. So that is the idea about dealing with the dismantling cost. Osmano Amakwan said, hi, Nhyira. I'm enjoying your lectures. Well, okay. Osmano, I hope that you are doing well. B Me Senior said, apt. Okay. All right. Any questions for me? Put it in the chat. Put it in the comment section. I'm going to read all of your comments. Make sure that you share the video. Let us reach as many students as possible. If you're getting value on the video, smash the like button on the video, and make sure that you subscribe to the channel if you have not subscribed. I don't know why you would not subscribe though, but just subscribe and make sure that you get notified when we go live. So let's go on. Subsequent measurement. So let's do a quick recap. We've spoken about the objective of the standard. We've spoken about the scope of the standard. We've looked at the key definitions. We've looked at the recognition criteria, and we've looked at the initial measurements. Now let's go to where many of you guys will be excited about, and that is subsequent measurement. Subsequent measurement. You ready for that? Let's go. Subsequent measurement. Subsequent measurement. Now, so after the initial recognition, remember the double entry I told you here, we debit property, plant, and equipment, then we will credit cash / payables in that case. Now, on subsequent measurements, we got to depreciate the asset. And there are a couple of methods of depreciation that we need to know about. There is a straight line method. There is the reducing balance method. And there is the sum of year dates method. But what we are excited about really are these two, the straight line method and the reducing balance method, because typically what you're going to be seeing in your exam hall is straight line method, reducing balance method, straight line method, and reducing balance method. That's what you're going to be seeing a lot in your exams in that case. So subsequent measurement. So before we dive into the depreciation method and all that, let me share some thought on some of the things that we need to take note of when it comes to dealing with the subsequent measurement. Before I get into the depreciation stuff, let's look at how we deal with subsequent expenditures. Subsequent expenditures. Subsequent expenditures. Subsequent expenditure is added to the carrying amount of the asset, but only when it is probable that future economic benefit in excess of the originally assessed standard of performance of the existing asset will flow to the enterprise. In other words, if after the initial recognition we incur some costs, it will just be added to the carrying amount of the asset. But the addition of that to the carrying amount of the asset is dependent on the fact that there will be future economic benefits from that cost we just incurred flowing to the entity, So the key thing that includes or that can be included in the carrying amount of the asset will be any cost we incurred in improving the condition of the asset. In other words, in improving the performance of the asset. In other words, improving the quality of the asset. So the important point here is whether any subsequent expenditure on the asset improves, keyword, the condition of the asset beyond the previous performance. So if previously the asset was operating at a capacity of 10,000 units per day, and there is something we can buy and we bought that thing, and now the asset will be able to provide 15,000 capacity per day, that means we've improved the performance of the asset. For that reason, what we just bought will be added to the carrying amount as at the date we bought it and subsequently accounts for it in that case. So the following are some of the examples of improvements that will be included in the initial cost. Sorry, that will be included with the carrying amount of the asset. 1, modification of an item of plant to extend its useful life, including increased capacity. This is what I just mentioned. So if we do anything that makes the life of the assets longer, that is like overhaul of the assets or maybe the engine of the assets. So anything that increases the life of the assets will be accounted for that way. Upgrade of machine parts to improve the quality of the output. Upgrade of machine parts to increase the quality of the output. Then adoption of a new production process leading to large reduction in operating costs. So our operating costs are going down. That means that we are improving the asset in that case. That means we are improving the asset in that case. So that is the idea about those subsequent expenditures. So remember, like I said, when it comes to the subsequent measurement, the key word we are after is depreciation. Depreciation. So when we say depreciation, what is depreciation? Remember that depreciation comes into the picture because of the fact that the entity is using accrual basis of accounting as compared with cash basis of accounting. And probably public sector accounting and finance students, later on, if you're doing that, you'll be able to know about that. Cash basis of accounting is where we recognize the transactions. We recognize the transaction when cash is paid or received. In other words, revenue is recognized when cash is received. Expenditure is recognized when cash is paid. But in accrual expenditure, what happens is that we recognize revenue not when cash is received only, but also when the transaction takes place. And we recognize an expenditure not when cash is paid only, but when the transaction occurred or the entity signs the contract or is obliged to make the payment in that case. So the need for the need to depreciate non-current asset arises from the accrual assumption. So in a simple language, let's take this definition here. 3 key things I want you to know about as we begin to talk about these. Depreciation is simply the allocation of the depreciable amount of an asset over its estimated useful life. Okay, allocation of the depreciable amount of an asset over its estimated useful life. So you bought an asset, you bought a plant, and you've decided that, oh, this plant that I bought, it's $1 million, $1 million. All right, and you're going to be using this plant for 10 years. Remember, this is a capital expenditure, so you can't write it off in the P&L account. You need to capitalize it. So after the capitalization, you need to now ask yourself, how do I share that over the 10 years? So the sharing of this 1 million over the 10-year period is what we refer to as what? Depreciation. And why do you do that? You do that because you are using the machine in your day-to-day running as an organization. That is why you depreciate the asset. But note that we don't only talk about depreciation, we will also talk about impairment of an asset later on in that case. Then depreciable assets are assets which are expected to be used during more than one accounting year, have a limited useful life, are held by the enterprise for use in the production of goods and services. Then depreciable amount of a depreciable asset is the historical cost other than the amount substituted for historical cost in the financial statement less the estimated residual value. So let's say this asset that I bought 1 million. I'm going to use it for 10 years. But I'm assuming that in the 10th year, I could sell this asset for whatever. Let's say 0.2 million, $200,000. Which means that the depreciable amount, DA, is going to be the cost minus the scrap value, the terminal value, or the residual value. So that's going to be my $1 million minus $0.2, which means my depreciable amount is going to be $8 million. That is the idea about depreciable amounts. So these are the key definitions that you need to understand. Any questions, please? Let me bring up some questions real quick as we continue with the discussion. Stan Obi said, okay, I understand. Okay, that's good. Tobia Ohamara said, please, I can't get all your videos on transfer pricing. PM. If there is any video you are looking for that you can't get on our YouTube channel, then you need to enroll in our paid program to get access to them, because not all content are available on the YouTube channel. So if you want to get access to all the entire content and get access to everything that you want, like this transfer pricing you're talking about, I did an extensive video on that. We solved questions using ACCA questions in that case. Then you can enroll in our full course online. It's 390 Ghana cedis or maybe 48 US dollars, depending on the exchange rates that you are using in that case. So if there is any topic you're looking for that is not on the channel, then possibly it's not available yet. Please, a brief description of ethics of accounting. I'm writing an exam about it tomorrow. You can check the channel. There is a video on ethics for accountant on the channel. You can watch the video on that. That ethics is a broad thing, and I wouldn't be able to go through that today. So we have videos on that already on the channel. So you can check the playlist on the channel, ethics. I think I did a 2-part or so, 3-part video on that, and you can look at it on the channel. George Archie, aristocrat. Hey, this guy's name is also George Archie. How can I get enrolled in the paid program? You visit NhyiraPremium.com. The link is in the description to this video, and then you'll be able to enroll directly and get access to the lecture videos. If you have any queries, also you can call or WhatsApp 050-114-9296, 050-114-9296. So this is the website. You can visit there. Once you go there, you go to the courses, and you can see the courses there. You click on Add to Cart. Once you click on Add to Cart, you'll be able to click on My Cart. Then once you click on My Cart, you'll be able to check out. You click on the checkout here. Then you'll be able to check out, make payment directly online using mobile money or any payment card, Visa or MasterCard in that case. So, George, that's how you can enroll. If there is any questions you have about the enrollment also, or clarification about something, you can call 050-114-9296. You can see the number below the screen, and you can call or WhatsApp that number for that. Right, so that is it about it. I'll be concluding around here today on our discussion as we look at it. And God willing, tomorrow I'm going to be coming your way as we continue with the discussion on the tangible non-current assets in the series of the IFRS masterclass. So tomorrow we'll look at the subsequent measurement in details, look at the methods very well. Then most importantly, we will be solving some questions, because remember, in this series, my focus is not just explaining the concept, but also solving quite robust questions for you to understand how the treatment is done. So you make sure that you stay connected, subscribe to the channel, click the bell notification icon. That way, when I go live, you'll be notified. Remember to follow me also on Instagram, because the discussion for the day and whatever development will be posted on my Instagram page, and you'll be notified as well about it. So follow me on Instagram. It's the same name, Nhyira Premium, as you see on YouTube and Facebook, and you will be getting notified. Nana AJ Sikapa said, good evening, sir. How does a company reassess the value of an asset if the useful life of the asset has elapsed but still uses it? Yes, they look at the recoverable amount on the assets. That is where we are looking at the concept of IAS 36. So they will look at the recoverable amount of the asset. The recoverable amount of the asset is simply the higher of value in use, and then fair value less cost to sell. So if the economic life of the asset has elapsed, but the asset is still in use, the entity will calculate the recoverable amount of the asset, which means if we should sell the asset today, how much will we sell it, and how much will we get less any selling cost? That is the fair value less cost to sell. Then if we are still using the asset, how long do we see ourselves using the asset? Maybe the year has ended, or its useful life as we thought has ended, but then we can still use it for the next 3 years. So if we can use it for the next 3 years, how much are we going to be getting from that? That is what we call the value in use, and we discount that into present terms. So we will compare the two, the value in use and then the fair value less cost to sell, and the higher of that will become the recoverable amounts. That is what we will use to place value on the asset whose economic life has elapsed. Then from there we will do subsequent measurements, depreciation, and all that in that case. So that is what you need to understand there. Stan Obi said, say, how do I get access to all your videos? You get access to all our videos by enrolling in our complete course. So if you enroll in the course, in the full course on our online portal, NhyiraPremium.com. The link is in the description to the video, to this video. When you enroll, you get access to the lecture videos. You get access to these ebooks that I'm using in my discussion. You get access to them. You get access to the question kits, and you'll be able to also join us live in our discussion and help you to prepare well for the exam. So that is how you get access to our content. So that is it about that. Thank you very much for joining the stream. It's always a pleasure coming your way. So this is the IFRS Masterclass, and we are covering the IFRSs. Like I mentioned in the introduction to the discussion, we have a couple of these videos already on the channel, but not structured the way that I am structuring it now, and with practice questions the way I'm structuring it now. That is why this IFRS Masterclass is unique, and it's different from what you'll be watching on the channel. But you can get access to some of the content in there. Like I said, our enrollment is ongoing, and we'll be starting with our live sessions from 5th of July 2021. As we begin the journey, we're going to be having 16 weeks going through the discussion for the ICA November 2021 examination, and I cannot really be excited about the period as we go into it. We're going to be having our regular sessions. We're going to be having some weekend sessions. That is going to be some extra classes. We're going to be having the Dawn project, and it was very interesting from 2 a.m., 2:30 a.m. to 5 a.m. as we solve questions, take the discussions, and let's see how we can assist you in order for you to prepare well for your examination, and most importantly, pass the exam. So I'll see you same time tomorrow as we continue with our discussion. Like I said, make sure you follow us on Instagram at Nhyira Premium so that you get notification on all our updates and everything that we are doing to assist you in order for you to pass the examination. So stay safe and stay blessed, and I'll catch you same time tomorrow at 5 p.m. Bye-bye.